Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Euronav stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Euronav engages in the transportation and storage of crude oil. The company is headquartered in Antwerp, Belgium, and was founded in 1995. It went public in 2004 and trades on the New York Stock Exchange, Brussels and London Stock Exchange, and Deutsche Börse. Its main competitors are Frontline, ticker FRO, with a market cap of 1.7 billion, and DHT, ticker DHT, with a market cap of 1.1 billion. It operates through the tankers and FPSO segments. FPSO stands for Floating Production, Storage, and Offboarding Operation. The tankers segment provides shipping services for crude oil. The FPSO segment receives hydrocarbon fluids pumped by nearby offshore platforms and also provides storage. Its activities also include cruise, ship, and fleet management services. It has a fleet of 74 vessels, 26 Suezmax ships. That's the largest ship capable to navigate through the Suez Canal. 44 VLCCs. VLCC stands for Very Large Crude Carrier. 2 FSO ships. FSO stands for Floating Production, Storage, and Offloading. It is different than FPSO, which stands for Floating Production, Storage, Processing, and Offloading. Since the company doesn't process oil, it just stores it for other companies. And they also have 2 V+. These are larger than the VLCCs. The company announced in mid-2020 its intention for share buybacks. We'll discuss the numbers later when we look at the statement of cash flows. People don't realize how much greener shipping is. It's 7 times more efficient than rail, 16 times more efficient than road transportation, and a massive 85 times more efficient than air transport. For a global industry to emit just 2.7% of the world's carbon emissions, this is not only a very efficient process, but the least impactful on the environment, particularly when taking into account the quantities and services it transports. You could fit a ton of stuff on a ship. As the world moves towards a more greener environment, shipping may play an even more vital role than it has before. There's also been a dramatic improvement in tanker oil spills. Back in the 1970s, there were so many oil spills, but tankers are safer and more reliable than ever. Let's get started with the model. This is a small cap company, 1.8 billion market cap. They're trading at $9.11 a share, and they have 202 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have negative free cash flow in 2018, but positive after that. 2020 was their best year in terms of free cash flow, net income, and revenue. A year most companies struggled. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative in 2018, positive after that. Revenue is the sales for the company, and that doubled from 2018 to 2020. It has slipped a little in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Their main cost of revenue is the payroll for their crew members. Also the cost of oil to transport their ships. Revenue minus cost of revenue gives you your gross profit, and that peaked in 2020 at 570 million. It's 270 million in the trailing 12 months. Below that is operating expenses, and then below that is operating income, which was negative in 2018, positive after that. And they paid $61 million of interest on their debt, which is the lowest amount they paid in the past several years. Then you have other income and expenses. These are non-operational gains and losses. They earn $11.6 million from equity interest. This is their earnings from investments in other companies. And the bottom line of the income statement is their net income, which was negative in 2018, positive after that. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So you can see they generate positive operating cash flow every year. It is small in 2018, but it is a lot in 2020 and the trailing 12 months. Then you have capital expenditures, which are investments in property, plant, and equipment. And those ships are pretty expensive. They spent $350 million in CapEx in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And they do have positive free cash flow every year except 2018. They also reduce their debt load every year. They pay down more debt than they issue. And they were paying a really nice dividend in 2020, but they cut their dividend. But it looks like they're buying back a lot of stock. They bought back $118 million of stock in 2020. That's another way to reward shareholders. When a company buys back stock, that decreases the shares in the market, making your shares more valuable. So you can see from this chart how they cut their dividend dramatically. It was over $200 million. They made a big cut in the third quarter and another big cut in the fourth quarter. But you can see they bought back a lot of stock in the third quarter because they had more cash than they anticipated. They cut the dividend to conserve cash from COVID, but they actually generated more cash flow than ever, so they bought back a lot of stock. So I think it's pretty likely they'll raise their dividend in the near future. Let's look at the capital structure. $2.2 billion of equity, $1.4 billion of debt. They're 61% equity, 39% debt, and their WACC is 11.5%. The weighted average cost of capital is a blend of the cost of equity and cost of debt. The higher the weighted average cost of capital, the lower the projected stock price will be. And the lower the WACC, the higher the projected stock price will be. So if you invest in a safe bond, the WACC may be 2-3%. It's very low risk. But the more risky the investment, the higher the WACC. So this is a pretty high weighted average cost of capital. That will lower our present value of future free cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year that's $4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.4 billion. We divide that by 202 million shares. And we get a calculated stock price of $17. They're trading at $9, so they're trading at a 47% discount. It's a strong buy according to the model. But just because a stock is undervalued doesn't mean people are willing to pay that price. An item is only worth as much as someone's willing to pay. And at this point, investors are only willing to pay $9 for the stock. The reason they don't pay $17 is because they may feel the future of the company isn't going to be strong. You may see stocks with the exact opposite situation, where the stock price is $17 and the valuation is $9. People are willing to pay more than a stock is worth because they feel the future of the company is going to be strong. This is a difficult industry to turn a profit. A lot of companies in this industry tend to struggle. So that could be a big reason why investors are not willing to pay more than $9 for this stock. Simply Wall Street also thinks the stock is worth a lot more. Their valuation is $18.44. 5 analysts priced this stock and the average price target was $12. The low was $9.50, the high was $15. Here's a recent article about private equity firm Kepler. They kept their buy rating on this company and their price target was 12.5 euros. And according to this article, 7 analysts had a moderate buy rating on this stock. Average price target was $12, the low was 10, the high was 15. Here's the stock price since 2015, and it did fall below $7 at one point. It peaked above $16 at another point, and that was right in the beginning. But you can see the stock trades in a pretty tight range. It's not too volatile. Most stocks have a much larger variance. It only a little more than doubled in 6 years. And this is the stock price in the last 12 months. The low was $7.20, the high was $10.30. And pretty much the entire time it's between these two lines. It did pop out a little bit on top, but it came right back between the lines. And it also came below this line at some points, but it came right back up. So it does trade in a pretty tight range. So this company seems to have a history of cutting its dividend. It was paying a really high dividend in 2015, 16, and part of 2017. Then it cut it all the way down to 6 cents. Then it raised it a lot in 2020, then drastically cut it again down to 9 cents and 3 cents. But I think the dividend is coming up, but they're all over the place with their dividend payments. Most companies try to keep it steady or increase it little by little every year. They pay a 1.3% dividend. They pay out 14% of their net income and 7% of their free cash flow. So they definitely have a lot more money to pay out as dividends if they wanted to. Their industry pays a 4.7% dividend, so they're a lot lower than their industry. Analysts are forecasting their dividend to grow to 3.5%. I definitely agree with this. I'm pretty sure they're going to raise their dividend this year or next year. They have a beta of 0.05. Cash has a beta of 0. That means if the stock market goes up or down, the value of that cash doesn't change. This implies the company has no risk. I would take this with a grain of salt. The company is definitely not risk-free. And they've gone up 15% in the past 52 weeks, while the S&P 500 went up 38%. The 52-week low was 720, the high was 1030, and the stock is trading above its 200-day but below its 50-day moving average. About 1 million shares are traded each day on this stock. Of the 201 million shares outstanding, 180 million are on float. The 21 million of shares not on float are held by insiders and cannot be purchased. 37% of the shares are held by institutions and 1% are shorted. In the past year, this stock has struggled, only up 18%, while its industry is up 58% and the market 47%. But in the past 3 years and 5 years, this company has done a lot better than its industry. Its industry has really struggled, but it's done a lot worse in the market. Analysts are bullish on their earnings, expected to grow 90%, much more than its industry in the market, but they only expect their revenue to grow 9%. In the past 5 years, their annual earnings increased 16%, much better than its industry, but in the last year, their earnings really suffered, same as their industry. If you invested $10,000 into this company in 2015 and reinvested the dividends, your investment would have been up and down a lot, but you would have made 17%. That's only 2.5% annual return. M&G Investment is the biggest shareholder at 5.4%. They own almost 11 million shares. Two more shareholders own 5%, then Vanguard and Norges Bank. Let's look at their financial ratios. Their PE ratio is 10.4, which is much better than the market median and average. That means investors are paying $10 for $1 of earnings. Value investors look for stocks with below 15 PE ratio. That means they have strong net income relative to their market cap. Their price to sales is also really good at 2.0, and their price to book is 0.8. When a company has a price to book below 1, that means its equity is greater than its market cap. Equity is on the balance sheet. It's total assets minus total liabilities. It's the value of the company. Their ROIC is 5.8%, which is lower than their WACC. You generally want to see an ROIC greater than the WACC. They can cover their interest payments 3.5 times. Their ROE is 8%. That's close to the market median. Their current ratio is 1.5, so they can cover their current liabilities 1.5 times with their current assets. And their current assets are 150 million of cash and 230 million of receivables. So the company does seem to be well capitalized. They have 367 million of free cash flow in the trailing 12 months, 145 million of working capital. Working capital is current assets minus current liabilities. And they paid $24 million in dividend payments, so they have nearly $500 million of funding. I saw some YouTubers mention this company might be headed towards bankruptcy, but it doesn't seem that way. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 45 midstream companies, and Euronav is better than average in all the price multiples. They also have a higher current ratio. They're lower in ROE than average. They're 39% debt, the average is 62%. And in terms of market cap, they're much smaller than the average. The average is over 9 billion, they're under 2 billion. And they do pay a lower dividend than average. So to summarize, I have them trading at a 47% discount, but this industry is plagued with difficulties. A lot of companies have really had a hard time turning a profit, but it's an industry that won't go away because it's a really efficient way to store and commute oil. It makes me think of the airline industry, how airlines have such a hard time turning a profit, so they need to get subsidized by the government. Maybe the government will start subsidizing these companies. I rank their free cash flows 5 out of 10, their revenue 6 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.